people know, anybody who knows Keystone knows we are stock investors. And what we do day in and day out is we research stocks, we research companies. A big part of that is looking at the financials, looking at the earnings, looking at the cash flow. So this is something that we've covered recently in our webinars, in our VIP in-person seminars. But I just wanted to pull out a couple of slides from that and talk about a subject that I think it should be important to most investors. And that's the subject of earnings quality. And really, can you trust earnings that are reported by a company on their financial statements, or the earnings that are then re-reported or redistributed by financial websites like Yahoo or Morningstar. So if you're an investor and you're doing a financial analysis of a company, you're going to spend a lot of time on something called the income statement. So this is where the company records all of its revenues, its expenses, and its profits. And right at the bottom of the statement, you're going to see something in every statement, a line item called net income or net earnings, net profit, net loss, which is going to tell you how much earnings the company has reported for that particular period. Now, the question is, can you trust this number? And the answer is no. Unfortunately, you cannot trust this number. And there's different reasons why. There is the possibility that there's dishonest reporting. But a lot of the times it has nothing to do with dishonest reporting. It's just the way the accounting system works. So there are major limitations to the income statement that people need to consider. And they need to consider this when they're using data that doesn't come right off of the income statement. Say, for example, if you're getting a price to earnings ratio or some type of financial information from Yahoo Finance, because their information, their earnings probably comes right off of the income statement. So one of the big limitations to the income statement is that net earnings may not be a good representation of real earnings. And so what would real earnings be? Well, real earnings is what we would consider to be the cash profitability that a company generates in a particular period. Now, one of the things about the accounting system is that we have these things called accruals. And that means that you want to match revenues and expenses that are associated with the same period in the same period. So you can be reporting revenues and you can be reporting earnings, but you don't necessarily receive the cash from customers in that period. Now, according to accounting rules, you would still report that as earnings on the income statement. And if you receive that cash maybe in the next period, it's not really an issue. But what happens if you don't receive the cash? So that's a major issue to consider. But there are also other items on the income statement, like gains and losses on financial instruments that don't impact the cash flow and aren't really part of the business operations. Right? So here's an example of an income statement. And if somebody were to look at this and go right to the bottom, they'd see 22 million in net income, up from a loss of about 11 million in the year before. And that looks really impressive. But once again, we can't just take this number at its word. We need to look through the income statement to see if everything looks legitimate. And right away, I can see a couple of things. Fair value on adjustment to assets, $46 million gain. Investment income, $1.4 million gain. So this is significant, and this needs to be considered. This brings up the subject of adjusted earnings. So you take the earnings that you get that are reported from the company, you go through the financial statements, and you make whatever adjustments that you need to make in order to bring those earnings at something that you consider to be close to cash flow profitability. So adjusting earnings is absolutely necessary when you're doing analysis. A lot of times earnings can be overstated, sometimes they're understated, but you need to know what goes into that figure. In Canada, typically we refer to this as adjusted earnings. In the United States, they typically refer to it as non-GAAP earnings. So just taking the previous example there, we had 22 million in reported earnings, but then we removed what we considered to be non-operating, non-cash flow relevant line items. So investment income, we removed the 1.4 million, fair value adjustment to assets, we removed the 46 million. And this brings our reported earnings down to our true adjusted earnings of negative 25 million. So we go from positive 22 million to negative 25 million by making these adjustments. But there are also risks to using adjusted earnings. There's also risks to making these adjustments. So a lot of times earnings will be overstated and you need to make adjustments to bring earnings down. But perhaps just as common, or maybe even more common, adjustments are made to reported earnings in order to make them look better than what they actually are. So some of the common adjustments that we see would be, of course, the non-cash gains, losses on financial instruments, like asset write-downs, other non-recurring expenses, maybe associated with researching acquisitions, stock-based compensation expense. Some of these, it's black and white. Should we adjust them? Others, there's an argument to be made on either side. But it's important to know what is going into the earnings figure. So one of the rule of thumbs that I look at is how far does the reported earnings figure deviate from the adjusted figure, and also how far from the cash flow. If the difference is fairly minimal, then it may not be something that you need to really spend a lot of time researching. But if there's a major difference, you really have to understand. So here's an example of a company that reported adjusted income from operations of 473 million for the year. But when we unadjust these earnings, we can see that the reported loss from operations was actually a loss of 411 million for the year. So going from a gain of or earnings, positive earnings of 473 million to a loss of 411 million, that's important. You need to understand what's going into that. Now, another way to assess earnings quality is just to go right to the cash flow statement. I talked about how the income statement was focused on matching revenues and expenses in the same period by using accruals. The cash flow statement doesn't care about that. It is purely about when the cash flow is received. So one of the questions that the cash flow statement can answer is, are the reported earnings actually translating into real cash flow? So cash flow statements are, often quite complicated. There's a little bit of a mess involved, but if you just focus in on some of the important line items, you can get a lot of great information. And I'm going to go back to that original example of the company that had 22 million in reported earnings, but those non-cash items on their income statement. So we could go right to the cash flow statement and we can see that those non-cash items, well, those items that we thought were non-cash items are in fact non-cash items. They're factored right out of earnings to get to cash flow. So positive earnings of 22 million is actually negative cash flow of 12 million. This would be an example of a company that essentially has no earnings quality. How do we measure earnings quality? Well, one way to do it, one really simple way, is just to focus on cash conversion. So that's just operating cash flow divided by net income. So what percentage of net income is turning into operating cash flow? We want to see this number meaningfully above 100%, definitely above 100%, ideally above 120%. Below 100% indicates lower earnings quality. And if you're getting into a situation where you have positive net income, but negative operating cash flow, then that's essentially no earnings quality. And I'm going to end this off on a positive, and I'm going to show you an example of a company that has a great cash flow statement and very high earnings quality. Right up here at the top of the operating section of the cash flow statement, you can see in the most recent year, they reported 606 million in net income. But when we go to the bottom, they've generated 1.5 billion in operating cash flow. So more than twice their net income into operating cash flow. So this is a great example of a company that we would have no concerns with respect to their earnings. In fact, their earnings are potentially understated in this case. And for anybody who's curious, the name of this company is Fortinet. It's a cybersecurity company that we've had under coverage for years.